Namaskar. Welcome to the Baroda BNP Paribas Outlook on Fixed Income. Today we have our Fixed Income CIO Prashant Pimple to discuss the market developments with us. Welcome Prashant. This month both the US Fed and the RBI announced their policy decisions. Do you think this pause in interest rates will continue, or do we expect them to pivot anytime soon?
Thanks, Siddharth. Hi, friends. Recently, we had Reserve Bank of India as well as US monetary policy. As far as US monetary policy concerns, they have paused this time as compared to a series of hike over last 1 year. And the main reason for this pause has been worry on inflation going ahead and also their concerns on growth going forward. As far as Reserve Bank of India is concerned, they were pausing since April policy. They have paused even in June policy. The reason for pause was again some bit of concerns on inflation going ahead and impact of the current monsoon as well as global monetary policies on RBI's policy going ahead.
So Prashant, what are your views on global GDP growth as well as the Indian GDP growth?
As far as GDP growth is concerned and global growth is concerned in particular, I think there are concerns as far as global growth are concerned, which are sounded by US Fed also, and we will see Bank of England and ECB announcing their policy in which they will sound similar concerns. As far as China is concerned, the global as well as local data, which is evident from imports and exports data, has been really weakening. As compared to the global growth and China growth, India's growth is quite resilient. If you look at three data pieces, one is auto sales, one is GST numbers, and one is PMI as far as manufacturing and services is concerned. All the three data has been quite encouraging. As far as GST numbers are concerned, the numbers have been quite vibrant over last couple of months, and that is helping our growth estimate to be retained by Reserve Bank of India going ahead.
On inflation, both US and India released their inflation data this month. Prashant, what is our expectation on inflation for FY24?
As far as inflation is concerned, I think Indian inflation is within the RBI tolerance zone of 4% plus minus 2%. But still the comfort zone of RBI for inflation has to be below 4%. And for that reason itself, we have seen a continuous pause in its monetary policy by Reserve Bank of India over last two policies. The main reason of his concern has been the current monsoon situation, which he needs to predict over next couple of months. Probably that's one of the reasons. And second reason is he wants to see how the global inflation is impacting Indian inflation. The main reason for global inflation to be sticky has been their employment data, which has been quite vibrant. Many of the economic indicators as far as inflation is concerned is also quite sticky, and that's the reason the view of Fed especially on policy which they have announced is that inflation is going to remain sticky, and to bring inflation down they need to compromise some amount of growth going forward.
Liquidity conditions have improved in recent weeks. What is the impact of this on the short-term rates, given that the Indian yield curve is flattish from the third year onwards?
Liquidity has recently improved from almost 50,000 crores positive to more than 2 lakh crores positive. The main reason for liquidity having improved is threefold. One is the excess dividend of almost 45 to 50,000 crores what RBI paid to the government of India. Second is the RBI announcement of discontinuance of rupees 2,000 notes, which is expected to add almost 3 lakh crore to the system, out of which most of the liquidity has hit the system positively. And the third reason has been FX intervention over last couple of months, which has improved the liquidity going ahead. The impact of increased liquidity has been mainly on very short-term assets up to 3-4 months, where the yield has corrected by considerable amount.
Prashant, how is the demand-supply situation panning out in the current market conditions?
The current demand supply situation warrants 10-year and above yields to slightly firm up. The reason for that is majority of the supply is concentrated in 10 years and above. That's the reason I feel that the gap between medium end G6 and long term G6, especially about 10 year, will increase over a period of time, and yield curve, which is flat currently, might steepen a bit from here.
And finally, Prashant, what is our expectation on interest rates, both at the short end and the long end of the curve going forward?
From liquidity perspective and demand and supply dynamics, and if you look at the view which is firming up as far as pause in interest rate goes, both globally and locally, I think investors willing to invest at the short to medium end of the curve should look at funds like liquid, ultra short term, low duration and money market from a short term fund perspective. From a medium term perspective, certainly they should look at schemes like short term fund, banking PSU, and any other fund having exposure to short to medium end securities. Investors considering investment into long duration fund will get an opportune time to invest into such funds over next couple of months as the expectation on pause reduces and economy warrants a downtrend in interest rates. And I think this opportunity will be there in early next year. Thanks a lot. Happy investing. Good luck.
Thank you, everyone. If you have any further questions, you can drop them in the comment section below and we would be happy to answer them.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.